And good afternoon, ladies and gentlemen. Welcome. I'm Randy Price. We are the Price Group, and we're glad to have you with us. We're going to be talking about a subject today that is ever more relevant given the current situation in Congress, et cetera. We're talking about tax strategies for retirement. Income tax planning is very important, but as you get to retirement, even more important. Who are we? Family owned and operated business. Myself, Randy Price, my son, Matt Price, between his 40 years of experience, we are a fiduciary-centric advisor and wealth management coach, and we are very passionate about everybody needs a wealth coach. So welcome. We're going to try to be right on time at about 30 minutes, give you plenty of information to take and ponder about. And our goal is for you to come away thinking, wow, that was a good 30 minutes of my time and well spent. About our firm, we do operate as a fiduciary. As I said, we just passed 25 billion in assets. Steward Partners Global Advisory. In fact, a new partner today in another northern state. We're not owned by a bank or brokerage firm. We think that is very important. We do use Raymond James as our back office. They took no TARP bailout in 2008. Remember the S&P 500, a very culture-oriented firm and fiscally conservative. So they've been a good partner for Steward Partners. Today's agenda, as we go through and look at things, we'll be talking about various sundry items. But Matt, excuse me, I got ahead of myself there. Go right ahead.
Yeah, Randy's just being humble. He doesn't like to brag on himself, but he's been honored with a few awards from Barron's, Forbes, etc. If you're not receiving our weekly market commentary, we'll make sure to add you after this, but we put out a couple of videos every week, typically a blog, our weekly market commentary, which is just some of the facts, the data. Randy and I both certified financial planners. We think education is very important. We both went to the Wharton School of Business to obtain our CIMA, Certified Investment Management Analyst designation. So a little bit alphabet soup there, but once again, think education is important. And back to the agenda.
So highly recommend the weekly market commentary. We try to make it interesting as well as a brief synopsis of what's going on in the world. So today, what are we going to talk about? Understanding the current landscape, and wow, that landscape is subject to change. Stay tuned for that. Also, some planning considerations and strategies. If you are retired or near retired, again, our goal is for you to walk away a much better educated consumer and understand really tax strategies and their current landscape.
So here's a look at some of the key metrics currently for 2021, and we throw this up knowing that a lot of these numbers will change, but we want to have a base to which we can compare it to. The top ordinary income tax rate, you can see here, 37%. This is something that's being talked about. The top long-term capital gains of 20%, and that's not really entirely accurate because you have to add this 3.8% net investment income surtax on that top 20%. That's being talked to move to 25%, and we have a few slides here in a minute that will get into the weeds of some of the items that has been talked about from the Biden administration on what they do want to change moving forward. But with that being said, putting in, call it 20,000 round numbers if you're under 50. That number is 26,000 if you're 50 or older. And really, unfortunately, a lot of changes to the IRA contributions moving forward, which has been kind of a gut punch because that's one of the strategies we like to talk a lot about as a way to really maximize some retirement savings moving forward. But we'll get to that in a minute, like we said.
So stay tuned. The Secure Act may lead to higher taxes for your heirs also for the changes to the IRA. Obviously, if you leave an IRA to someone other than your spouse or even to your spouse, there's a tax-free rollover. But in this law, the required minimum distribution age was raised from 70 and a half to 72. So that was good news. If you need to take money out at 70 and a half, you can, but you don't have to take money out till 72. Typically, about a 3.7% distribution rate. Traditional IRA contributions are allowed past age 70. The big change from the Secure Act was to stretch IRA. Under the new law, if you die and leave an IRA to someone other than your spouse, a non-spouse beneficiary must liquidate the inherited IRA over the next 10 years. So you could take zero out in years 1, 2, 3, 4, 5, 6, 7, 8, 9, but in year 10, you'd have to take out 100% of the money. Or you could take out 10% year 1, 10% year 2, 10% year 3, etc. Again, the planning comes in on what would be best for your situation. Where's your marginal tax bracket, as well as looking forward, what may the tax rates be on down the road. A lot of people have their ear to the ground with regard to the probability of higher income tax rates, and they may accelerate income. Typically, in the past, what you would do would be accelerate expenses and defer income. Now, maybe just the opposite is true in this new time. So, as I said, no annual requirements, but it all has to be out in 10 years. Could we see more changes? Oh, absolutely. Stay tuned and welcome to the world of politics. We think at some point the required minimum distribution could go to age 75. A lot of people say, well, why is there a required minimum distribution? We think the government wants to get people to have to start paying taxes on some of that money that they literally have not paid taxes on since they started to work at age 20 or started funding IRAs way back. Perhaps some additional catch-up contributions, that would be a good thing, or an expansion of what we call the QCD, qualified charitable distributions. One of the best kept secrets, unfortunately, right now, if you have a $100,000 IRA required minimum withdrawal every year, you can, rather than giving that money to yourself, taking it out of the IRA, putting it in an after-tax account, you can send that money directly to a charity or charities plural, and therefore not end up having to pay taxes, fund your charitable contributions that way, possible expansion of that, and then an employer match for what we call qualified student loan payments. So anyway, they're talking about a lot of things. Some changes could be coming. Stay tuned, and if you're on our distribution list, we'll make sure you know about the changes as soon as they happen.
And this slide honestly could have used a better subject line, so that's my fault. But these are not things that have necessarily been discussed here over the past few weeks with the Biden administration. But we do think the things currently listed are some things that we could see could be talked about here in the upcoming, whether it's months or into the next few years. So looking at fiscal pressures, drive need for more revenue. The government is spending a lot more money than they have historically. Whether you're a Republican or a Democrat or somewhere in between, most people will agree that there's too much spending going on. And so with that being said, that is kind of what has led to some of the potential tax changes that have been discussed. And so let's get into the weeds and sit here for a minute on what are some of the specifics as it pertains to retirement planning that have been talked about. Well, top income, 39.6, where it was prior to, for any couples with income over 450,000. The interesting one here of capital gains, the top rate going from 20% to 25%. And historically, we've had a good window from this being announced to when the law would go into effect, but they've made this specific ruling effective as of September 14th of this year. So what that means is there's really no room before 12/31 to sell some stocks in an after-tax account to pay the quote lower capital gains rate.
But there is time to do some income tax planning, so that has not been grandfathered. Hopefully that may change, but that's the sort of what the Simon says as of the current time. Doesn't seem fair to have a different tax rate for one day versus the next in the current year, but we'll see if that actually comes to fruition.
Randy, how about you talk about the lifetime gift tax exemption amounts and where they're going?
Yeah, if you're fortunate enough to have an estate, beware, because the amount of assets that you can pass to the next generation is changing. Currently, you can give over $11 million per person. So if you're a couple, over $22 million away without any estate tax, the government says that's fine. What happens is that is penciled in to change to 5 million. So if you have an estate of 11 million now, you could have some potential estate tax where the government would reach in and take a piece of that. There is some planning going on with folks doing lifetime gifts or some sort of trust in order to take advantage of the higher amount. That will not change until the first of the year, but they're reducing what we call the lifetime gift exemption to the pre-2018 levels, 5 million per person. That started out at about 600,000, so it's much better than that. If you're an estate less than 5 million, you can say, well, hey, I'm not going to worry about that, but that could very easily be lowered back again below the $5 million threshold. If you own a business, if you own farmland, et cetera, could be very critical for you trying to pass a business or a family farm on. And also there's an additional 3% surtax. How about that? On income over 5 million that will be effective January 1st. So again, we may see people start to accelerate income, do Roth conversions, et cetera, in order for a way to mitigate some of the teeth of these proposed law changes. Again, hopefully some of this doesn't come true, but this is what's laid out right now and what we're planning and expecting in the very near future. First of the year will be here. October the 1st is Friday. So be here before you know it, 90 days or so.
A few more changes that have been talked about. You're using a backdoor Roth, or if you're doing the mega backdoor Roth, and we've discussed these in a few webinars in the past, but backdoor Roth is where you put money into a non-deductible IRA, and then the next day you just do a Roth conversion. There's a caveat there on the pro rata rule. This should not be done if you're looking to not pay taxes, if you have other pre-tax IRAs out there. 401ks do not apply, and that's getting a little bit into the weeds. But this has been a strategy that they've made it a little more difficult to do that. They're not allowing Roth conversions for couples with income over $450,000, but they left the door open for the next 10 years on backdoor Roth and mega backdoor Roth, but that will close, as you can see, effective December 31st, 2031. That's not a typo, but in 10 years. So they're trying to reduce it for high earners, and typically it's been the high earner who has found the backdoor Roth or the mega backdoor Roth of interest. Then they've also said certain taxpayers that will need to withdraw 50% of the value of their IRAs for people who have IRAs over $10 million. That's not of the whole amount, that's just over the amount above that $10 million threshold. How will they monitor this? I'm not entirely sure, but it is something that has been talked about. So you might say, hey, my IRA is not there. It's $5, $6, $7, $8 million, whatever the number, but another few good years in the stock market, and this could be something to consider. And so our point would be, let's have a conversation. This is a lot of generic information. Let's look specifically at your situation and what, like Randy said earlier, we're going to see probably a handful of clients taking income earlier before this year, whether it's for a Roth conversion, to spin down some IRA, to make more gifts, go down the list of things to discuss. But a lot happening here, and it's made what we would argue already a complicated tax law a little more complicated.
Our caveat would be we always want to involve your CPA, make sure your specific situation with your deductions and income sources, but it is certainly not too soon to be thinking. You've got obviously 2 big holidays toward the end of the year, and with 90 days left, what you don't want to happen is the middle of December to think, well, I should be thinking about this, and then have to spend, try to find your CPA and spend some of your Christmas vacation perhaps doing this. So again, Matt's thought to have a conversation early, I think is very good advice. So let's talk about planning considerations and strategies here. What do you want to do to save on taxes? Well, how do you maximize some popular deductions? Obviously, the property tax is limited. We've got some lower tax brackets this year. We've got estate planning under the new law. The good news, if you will, from some of the proposed changes is the step up in cost basis did not go away. So if you own a stock at $10 a share and one of your family members, your wife or husband pass away at $50 a share, that $40 a share gain is not taxed. So there is some planning as a result of the Secure Act, but again, there are some actionable planning strategies that will be peculiar to each family, each situation, each circumstance. And now is the time to start looking at things for tax year 2021/22, because again, there's a great amount of uncertainty as well as potential planning. Some doors may be shut. So this is a time to really do a little study and say, you know, this might appeal to me, this might help me and our family, and put something into place. We're happy to sit down with you and or your CPA to have that conversation.
And one more thing to add to that, Randy, prior to the Secure Act, you had to take out, like you said earlier, 3.7% starting at age 70 and a half. Now we're starting at age 72 for those required minimum distributions, but it was a set number that you had to take out. And so the planning has actually become much more robust in the fact that you don't necessarily have a specific time horizon with an inherited IRA of when to take it, but you have that 10-year period. And so we think our Live Well plan is a great tool to help make some of these what can seem like complex and confusing situations.
So some people will lump their charitable gifts. We have the assumptions here, husband and wife, both age 65, they donate $10,000 annually to a charity or charities. They've got $10,000 in state and local taxes, that's SALT, $7,000 for mortgage interest, and their marginal income tax bracket is 22%. And so what happens is rather than doing part of it in 2022 and 2021, you'd make your gifts perhaps in 2021 to get above the standard deduction amount and be able to itemize, and it can save you a few taxes there. Again, bunching, maybe you use the standard deduction in normal years and then you itemize in every other year. So this has worked well, but again, the deductions keep going away. Mortgage interest is limited. Your state and local taxes are limited. And so we're searching for ways in conjunction with your CPA to say a day can make a difference as far as how much tax you pay. And if so, we smile with you all the way to the bank. Donating
briefly earlier, but donating IRA assets to a charity, this is still one of the best games in town. You don't have to be 72 like the required minimum distribution. You only have to be 70 and a half. You can give out of your IRA directly up to $100,000 a year. We're doing this for probably a couple dozen clients, I would say, each and every year, giving to whether it's their church, charity of choice, and in lieu of having that as additional ordinary income, we're sending the funds directly from their IRA to their charity. So lowering that their taxable income and still at the same time being able to use that standard deduction. So you're double dipping and it's 100% legal. Talking about Roth conversions, it would be our guess that we're going to see more Roth conversions between today and the end of the year, just based off the fact that Roth conversions are going to become, for higher earners unobtainable starting next year. And then with that being said, some of the tax rates moving higher. But we would say for someone that is retired or maybe retiring here in the next few years, a strategy we talk a lot about is, say you're making $200,000 a year at your company, you retire at the end of this year, and next year you don't necessarily need any income from your IRA because you have after-tax dollars to support your lifestyle, but you want to utilize some of those lower tax brackets. Well, a Roth conversion for a piece of your IRA is a great tool for that, to parlay into whenever you do start needing the income from the IRA. We think it's a great honor in this country to pay tax at a 10 and a 12% bracket, but this type of planning is something we incorporate inside of our Live Well plan as well. And like we just said, Roth accounts can help hedge against higher rates. Obviously, that money's not growing tax deferred in a Roth account, it's growing tax free. Distributions from a Roth IRA are also tax free, and that's typically the best type of vehicle for legacy planning, passing on to the next generation as well.
So estate planning, not a lot of fun to talk about death and dying, but estate planning is part of the education that you need. And as a wealth coach, it's part of our things that we check the list to make sure you're thinking about those. Review your existing estate plans to determine if changes are needed. The good news is we do not have any state death taxes. You've got low cost basis property. Again, stepped up cost basis is maintained when the property is transferred. That did survive, and so we're positive on that. And then high net worth families may want to consider a gifting strategy for the lifetime exclusion amount. So if you've got a lot of money and you're thinking about doing a family foundation, you're thinking about doing a donor advised fund, you're thinking about giving some gifts to various charities, that can happen this year, and there are some advantages to it. So again, perhaps the CPA, but we have the state planning attorney involved to make sure things are well for you. You know, it's interesting on estate plans. A lot of people we talk to, well, they were done when the kids were 2 or 3. The executor may be the substitute executor may be old or moved away, or they may have passed away. The children may have trust that you don't need or want. So again, just the people that are going to be involved in the state administration or the trust management, we need to make sure that those are up to date. Plus, several law changes that have gone on. So if your estate plan's rule of thumb, they ought to be reviewed every 2 or 3 years. And typically, if they're 5 to 8 years old, we may need to make some changes.
This slide's a little bit dated here, Randy, but we're almost kind of talking the reverse. So we're talking here on the exemption moving higher, and like we discussed, it's moving back close to that $5 million level first next year. But go ahead.
Yeah, so it just shows how the law can change, and how planning needs to be a priority for everyone, especially if you are a high net worth family. We're not just planning on what your net worth is now, but let's say that you're planning and you're 58 or 60 and you're worth $7 or $8 million and you live to 90. What are the chances are your estate being substantially higher than that in the future? So you need to have estate plans that will accomplish what you're trying to do. Again, taking into account the estate planning that's applicable by law, and seeing the estate planning attorney. We like, if that estate planning attorney is a board certified attorney, to make sure your estate plans are up to date and suit your family for your needs, wants, and desires. So again, we talked a little bit about the 10-year rule on inherited retirement accounts. You need to be careful with your beneficiaries. A spouse can still stretch the IRA out. But if you're an heir and you're getting a inherited IRA, your aunt, your uncle died, does it make sense to withdraw over the 10-year period or all at once? You could leave the IRA to a charitable trust. You've got life insurance. Again, there's different ways to be charitable, the different ways to give assets away. And again, the tax laws always seem to be in flux. And so there's where the benefit of a wealth coach to make sure we take into account cash flow, investments, insurance, estate plannings, looking at everything from a holistic point of view. But tax planning, like we said, is going to be paramount for the next 90 days as we move into the new tax year, 2022.
And what specific documents do you need to get from an estate planning attorney? Here would be, we think, at least a starting list. You need a will. You need whether it's a will or revocable living trust, you need a power of attorney. We like that power of attorney to be durable, meaning it transcends disability. We like that durable power of attorney for health care as well. And, if you have children that are that are still minors, guardianship papers are obviously included. And so that's kind of the base layer, and then the attorneys build from there. We don't write the documents for clients, but we work closely with estate planning attorneys. One thing we will say is when you are interviewing an attorney, something we think is important to consider is, are they board certified? Board certified means that they specialize with estate planning, probate, and this is all they do. They don't do divorce law on Monday, corporate law on Tuesday, and estate planning on Wednesday. They solely focus on estate planning, which we really like and typically recommend for clients.
So we think everyone needs a wealth coach. Hopefully that doesn't sound too corny, but our coaching involves what we call the Live Well plan. We want all of our clients to live well. So our number one suggestion for everyone is to have some semblance of a written plan. Create, if you've already done, update your Live Well plan. Retirement's not an event, it's an ongoing process. For some of you, you're going to be retired as long as you worked. The plan's not written down, it's not meaningful. Our retirement plan tells you how much can you spend in retirement, how long will your money last, what rate of return do you need during your retirement. We call that the family index number. And what sort of investments do you need for your portfolio in retirement? Benjamin Graham, who's a buddy of Warren Buffett, said the best way to measure your investing success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline. That's key behavioral discipline that are likely to get you where you want to go. So again, we highly recommend that and can entertain questions from you on what that looks like.
And part of that Live Well plan, we're developing what we call our family index number. What rate of return do you need to get from here to there? And so we're not going to be maxed out by this number, but we want this number to be our average rate of return over a market cycle. So factor in a bull market, factor in a sideways market, factor in a bear market, and we would love for you to average this family index number. Now, the real caveat is what happens with interest rates. A lot of family index numbers are lower than normal just because the 10-year U.S. government bond, which is our barometer for where interest rates are, is hovering around 1.5%. And compared over to the last 10, 20, 30 years, that's relatively low. So if and when interest rates do move higher and we can get pick a number, 5% on a CD, corporate bond, whatever it might be, well, your stock versus bond ratios are going to change, but at the same time, when you're able to get more income interest from bond payments, typically inflation is right behind it. And so it's an ever-evolving number that's peculiar to your family, but right now, like we said, some of those numbers are a little bit lower just based off of interest rates. So we'd love to create a Live Well plan for you if you'd like. There's no cost or obligation. Randy and I, we view ourselves as teachers, as educators, and at the very least, our promise is if we don't end up working together, you're going to leave a more educated consumer which is always our goal whenever we get together, whether it's in person or virtually.
So some of the folks joining us on a Zoom event like this will be interviewing an advisor or a group to help them with their retirement. And so we've got some talking points here that we think could be very helpful with regards some questions to ask when you're interviewing a team. Do they follow a fiduciary standard? Does the advisor represent you or the bank or the brokerage firm they work for? Do they have a transparent cost structure? Fiduciaries looking out for your best interest without having to be told. What is the experience of the group? Are they certified financial planners? Do they hold their certified investment management analyst? Those are analogous to somebody's doing your taxes. You'd rather somebody be a CPA because that shows that they are committed to the profession. That shows that they've taken the time and effort to be further educated and to be top of their game. What's their experience? Does the firm have a succession plan? Do you have an individual or a whole team? We're all about the team here supporting you. What is their niche in doing business? 90% of our clients are retired or approaching retirement. You need to have a personalized strategy, not a cookie cutter approach. We have a low client to advisor ratio. We think that's very, very important. And really last but not least, how does the group communicate with you? Do you get communication on a regular basis? Do they reach out proactively to communicate with you? Part of our communication is in our weekly update that goes out. Part of that is in our written holistic wealth plan. Do they anticipate your needs? And do they have systematic outbound communication? So if you want to have a resource here, you can request our complimentary guide, 10 questions you should ask your financial advisor. We'd be happy to send that to you. So we appreciate your time. Please feel free to reach out to us with your questions or your comments. That's Maddie, that's Tiffany, myself, Matt, and Melissa. Again, indeed, we are the Price Group. Again, we're passionate about wealth planning. We think everybody needs a wealth coach, and we'd love to hear from you. Telephone numbers and email address, information on the website. Thanks again for your time. And Matt, unless we have some questions that came in before we started, we are right on time and done for the day.
Good. Yeah, no questions now. Shoot us an email. If you do have a question, give us a call, and we appreciate y'all's time.
Thank you. Have a good afternoon. Bye-bye.